All right, let's get right into it. We're going to break down a tax mistake that is so common for divorced parents, but man, it can be incredibly costly. We're talking about the Child and Dependent Care Credit. It sounds straightforward, right? But the rules are tricky and can set a serious financial trap if you're not careful.
So picture this. You're divorced. You're the one paying the nanny or the daycare so you can go to work. It seems like a no-brainer that you should be able to claim that tax credit. But can you? Well, the answer is a lot more complicated than you'd think, and getting it wrong is surprisingly easy.
And I've got to tell you, this is not some minor little error that's going to fly under the radar. The IRS has seriously ramped up its game here. They're using powerful data analytics to spot any inconsistencies, and they're paying special attention to filings from divorced parents. The stakes are just way higher now. To really understand this, we have to get down to the one core principle. When it comes to the child care credit after a divorce, the IRS has an unbreakable rule. It doesn't care who writes the check. It cares about who has the child. The key to this whole thing is wrapped up in one very specific definition. For the IRS, the custodial parent is simply the parent the child lives with for more than half the year. That's it. Count the nights. Whoever has the child for more nights is the custodial parent, and that single fact determines who can claim this credit. Now, this is where the biggest myth comes into play. So many people believe that Form 8332, that's the one that lets the non-custodial parent claim the child as a dependent, also passes along the right to the child care credit. Nope, absolutely not. That form only transfers the dependency exemption and the child tax credit. This child and dependent care credit, it's totally separate, it's non-transferable. It always stays with the custodial parent. And listen, this isn't just some clever interpretation. It is written in black and white in the IRS rulebook. The right to claim this specific credit stays with the custodial parent. Full stop. And get this, even if your divorce decree says something different, when it comes to your federal taxes, the IRS rules always win. Okay, so we've established custody is king. But even if you are the custodial parent, you're not automatically home free. There's another huge pitfall, especially for anyone who pays a nanny. We call this one the hidden nanny trap. See, if you're paying a nanny directly, the IRS views you as a household employer, and that comes with a bunch of legal baggage like withholding and paying Social Security and Medicare taxes. If you just pay your nanny under the table, you've instantly disqualified those expenses for the credit. Why? Because without that proper paper trail, the IRS can just argue those payments aren't a legitimate work-related expense. They're just a personal child support payment. This really highlights the dangerous gap between what seems like common sense and the harsh reality of an audit. You hear stuff like, oh, just keep your receipts. But for a nanny, receipts are basically worthless without proof you followed all the employment tax laws. You hear, hey, if you pay for it, you can claim it. But the reality is, if the IRS decides those payments are just part of your support agreement, they'll deny them as a personal expense, not a work-related one. So, what really happens if you mess this up? I'm telling you, this isn't just about having to pay back a small credit. The financial risks are huge, and they can set off a really devastating domino effect. Let's start with the immediate hit. First, boom, the credit is disallowed. You owe that money back. Then, the IRS slaps you with an underpayment penalty, which is usually around 20% of the tax you should have paid. And the whole time, interest is just ticking up on the entire amount. It gets ugly fast. But that's just the opening salvo. The real danger is a delayed chain reaction that can be absolutely devastating. Tax professionals actually have a name for it. They call it the double torpedo. And this is where a tiny tax mistake can explode into a massive financial crisis, sometimes years down the road. Here's how it plays out. Step 1, an audit says, nope, you can't have that credit. Step 2, because you lost that credit, your adjusted gross income or AGI gets recalculated and goes up. Step 3, that new higher AGI suddenly pushes you over a threshold that makes your Social Security benefits taxable. And step 4 is the second torpedo. 2 years later, that higher AGI from the audit year is used to set your Medicare premiums, and they can spike big time. Just pause on that number for a second. 85%. A single, small, disallowed childcare credit can bump your income just enough to cross a line you didn't even know was there. And the result? Up to 85% of the Social Security benefits you were counting on for retirement can suddenly become taxable income. It is a huge, shocking financial blow, all triggered by one little mistake from years before. And the risk isn't the same for everyone. It gets worse the more you earn. Take a look. A simple $600 credit mistake costs a household making $150K about $720 plus interest right away. But for a higher income household, that same $600 mistake can trigger a whole cascade of other problems: extra investment income taxes, that Social Security tax torpedo, and those painful Medicare premium hikes. The higher your income, the bigger the long-term danger. So here's the bottom line. The rules here are not intuitive at all, and the consequences for getting them wrong are severe. It really forces you to step back and ask a critical question about your own situation. Is your divorce decree a tax trap in disguise? Is the way you've structured childcare payments setting you up for a nasty surprise from the IRS? It is absolutely worth taking a second look.